Now, in looking at member choice over the last 3 years, there's really two stories to be told, or two groups of members to talk about. The first overwhelming majority of members, or group of members, made no change over a 3-year period. 7% of members, or less than 7% of members, made a change. And if we further break down that 7%, 80% of those 7% made just one change over a 3-year period. So a very small proportion of members make a change. So the first group, I guess the overwhelming story, is that most members stayed where they were with their investment choice at the beginning of the time period, which for most of the funds was June 2006. But then the other story to talk about is those who did make a change. And the top figure there identifies the patterns in choice over time. And towards the right-hand side, you can see the twin peaks. You've got October 2008 and the bigger one in March 2009. They're the relative peaks in activity. And the bottom figure identifies a general decrease in risk level of those choices over time. It's not uniform, and there's peaks in between. So from my point of view, they're interesting, as well as those who have stayed in the default or stayed with their investment choice. The overwhelming message that was delivered to fund members during the financial crisis was don't change. Don't change your investment strategy. And that was delivered by funds. Funds emphasised even more the long-term nature of superannuation. Investment horizons got longer through 2008. Funds emphasised the long-term nature, the long-term history of the share market and the volatility that we'd seen before. And funds also identified that those members who did move to lower risk options would miss out on any upswing, which has subsequently happened. The same message was delivered by government. It was delivered by the regulators, or various regulators, ASIC, and it was delivered by industry from various groups, including the superannuation stakeholder group. So that was the overwhelming message. What level of activity should we expect to see in these sort of funds? Well, much of the evidence suggests that it's quite low. We know in Australia that it does vary by fund type. If we look to APRA data, it identifies, if we just take the crude measure of assets in the default option, it varies by fund type. Some of the few studies that have looked at the level of choice that have published results also identify a reasonably low level of choice, barely getting out of single digits. And that matches what's happened internationally. There's some studies, there's one US study identifying that over a 10-year period, 75% of members don't make any choice. So low choice is by no means rare. Why would a member choose to make a choice, make a switch, or why would they choose to rebalance? Well, normally we would say that any choice would be prompted by some revision of expected returns or revisions of the risk of the options, or perhaps if their risk attitudes changed. There might be some automated triggers that people use, such as that they might review their position each year. If they're getting more sophisticated, they're looking at changing their asset allocation within certain bounds, or if it goes outside of certain bounds. Some studies that have had a look at rebalancing activity to see what's the optimal level of rebalancing, one that looked in particular at retirement savings in the US, identified the benefits to members of rebalancing, and more frequently than perhaps we may think, one suggesting even quarterly was of benefit for individual members, but settling on about a year on an annual basis. The caveat there would be that there's also evidence showing that excessive trading or excessive changes is detrimental, so it will reduce the benefit. So the funds that we have, I won't talk too much about this table. It just compares the profile of the funds to the APRA data, some selected APRA data. So In total, the funds have more than $70 billion of assets, 3.4 million members. In terms of choice, as I mentioned, it's under 7%, but it varies anywhere between 5 up to 6.6% of members making a change. Now, some of those members, as I said, made more than one change. There were some quite trigger-happy members making more than 100 changes in a 3-year period, but the vast majority of members made just the one. Here we've got a fairly colourful set of lines. Again, it identifies several things. One is funds themselves influence choice in their communications with their members, notably the annual report or annual statement when it goes out. Fund rules and constraints also influence choice. The third fund there, the black line, if you can distinguish the black line, it allows monthly trading, whereas the others allow daily, stretching out a few days, and it becomes effective a few days after that. So in effect, the black line has been brought forward a month to bring it in line. And that raises some issues which I'll touch on a little later on. Now, in terms of risk changes, perhaps one thing I should mention on that previous one, you can see there on the axis I have normalised trading activity. Because the funds vary in size, just looking at the actual number of changes is a bit misleading. So I've standardised the levels of activity across the funds to make some sort of relative comments. In terms of the level of risk, the data we had focused on balances and contributions. With the exception of one fund, members were able to make an investment strategy choice for their existing balance, and they were also able to nominate a separate investment strategy choice for their future contributions. But we had different data for each. For balances, what we knew was where money came from and where it went to. We didn't have the total. So if, for instance, 50,000 came out of equity, but there was a total of 100,000 in equity, we didn't know what was left. We only know that money came out and money went to another option. Whereas with contributions, we did have the percentage allocation across each. But as it turns out, they're very similar. And they allow different sorts of analysis to be conducted. In terms of risk, you can identify different periods of time there, up until about July 07, even though markets had experienced ups and downs prior to that period. Risk changes and risk levels were generally positive. Then there was a correction, it goes down. It increases again when markets rebound. Then we get to the peak in late October, early November, and then significant activity, and then significant drops in risk levels, which then rebounds again when there's a slight correction in the market, and then it significantly goes down before reaching bottoms in March 2009. This graph tells us that those who made a change really appear to be influenced by the short-term movements. On the right-hand side, the red line captures quarterly all ordinaries returns. On the left-hand side, with the bars, is the risk. So you can see that when the markets increase, members increase or they maintain their risk. When markets decline, members reduce their risk. With a little caveat, if you look to the right-hand side, and you can see from March 2009 when when the market started to rebound, members were a little bit gun-shy. The activity really dropped, and those who were going back in weren't dramatically increasing risk at that time. So whether that is a long-term change, it'll be interesting to see what the data shows for the 6 months after, to see if that persists. Those who made changes were generally older. They had larger balances, which goes along with being older, and they made larger contributions. But age appeared to be the biggest discriminant. So even though they're correlated, age is the better one to make a contrast between those making changes and those not making changes. Just to give you an idea of that, in April 2007, so on the back of about 9 months of positive market performance. The average age of a changer was 40 years. Move forward to, that should be October, November 2008. The average age was 48 years. Things changed. There's different points in time where profile of people making changes really switches. And around December 2007 or November 2007, it switches from the oldest age groups being the least active to the oldest age groups becoming the most active. And there's also some subtle changes on the bottom graph when you look at risk levels. Generally, there's a negative age relationship with risk, but there are differences. If you look at the very early period, there's a tighter relationship between age and risk. And if you move towards March 2009, again you can see the tightening, where those going back in and increasing their risk level. It's not just younger age groups, it's across each of the age groups. Looking at gender, there's some subtle differences. I've got an asterisk there reflecting that generally males are more likely to make changes across the whole period. There's some evidence to suggest that again before December 2007, males are more active, but post that time females became relatively more active. In terms of the risk level, the red line there is female members, and it suggests that before the peak of the market, female members were making larger risk changes, and that then switches after December 2007. But when we look at a different way to measure risk, if we just look at the risk level, it doesn't support that as much. But when you dig down into the actual asset allocation, there is support for there being something different happening. Up until December 2007, there's not a significant difference between exposure to equity cash. If you look post 2007, there is significantly higher allocations to equity for males and lower allocations to cash, which is consistent with other evidence on risk levels by gender. Now, the previous sets of figures focused on averages, so we don't track individuals over time. And that's where this graph actually tells a little bit more, because what it does is it picks out where the last choice a member made was at. So it looks at the distribution across the membership by age, not age yet, but it looks across risk and over time. And it clearly identifies, this is actually not as clear as some of the other funds, but it clearly identifies that red line, those red blocks, so they're the people who are moving into the lowest risk options. So you can clearly see the peak there in October 2008, and then again in March 2009. So even when the market is rebounding in March through to June, the dominant move is still into the lowest risk category. Now, 80% of those members, that's their one and only change. And one of the things that I'll touch on later on is what's going to be the impetus for those members to get out of those changes, particularly those in the lower risk options. Because if we look by age, this graph now looks at only those lowest risk options. So only the people that have moved into the lower risk options, it looks at what was their age. Now in that bottom graph, if you just focus on the red is the oldest age group. So you can see that over time, it's the oldest age group who is moving into the lowest risk options. But importantly, it is not just the oldest age group. It's across the board. So there still are other members moving to those low risk options. And equally, when you look back through time, no one age group is excluded. If we look at the overall asset allocation of the members at the beginning and the end of the time, there's two figures here. The top one identifies those people who made no changes at all. The white box represents equity, the aqua, that's cash. The bottom figure represents those members who made changes. So for this particular fund, the average exposure to equity actually went up for those who didn't make a change. And that's a bit of an artefact of a change in the default rule for that fund over that time. So it wasn't a specific strategy of the fund to increase exposure to equity. But if you have a look at the bottom graph there, equity declines, cash increases. If we look at two of the other funds, just focusing on the bottom two graphs, again it highlights the change, the reduction in equity and the increase in the amount of fixed interest and cash. And just to dwell on the middle figure on the bottom, you can see that the decline in equity is put into fixed interest and cash, whereas if you look at the other funds, the third fund there, on that third bottom figure, it has a much higher aqua, so it's got much more cash. Now, it doesn't necessarily reflect that members of those particular funds had a particular focus on cash or fixed interest. It again reflects the options that are available to them. So what the fund offers, how it constructs its menu, even for those people who make changes, it fundamentally influences what their portfolios end up looking like. So there's choice, but it's constrained choice. So why so few changes in response to the global financial crisis? Is it fair to say that it reflects general apathy, or is it fair to say that it lacks, or it's evidence of a lack of financial sophistication? That was some quotes from the press. I don't think that's necessarily true, and I think it's oversold a bit. I think we can provide a defence for those people not making changes. They did exactly what they were told to do. The government, their fund, the regulators, they all were telling them, don't make a change to your investment strategy. And also, I think we can't overestimate the implicit recommendation that comes with funds default, how a member sees the investment strategy that they have has been devised for them by the trustees, which was again emphasised to members in the 2008 report. So what about for those who did make changes? What's prompted them to make their changes? Well, there's no doubt that the poor returns became much more salient through that time. You know, if you think back to October 2008, it's a very different time. It's hard when you look at the market today to think how different it was at those times and the sort of dire predictions that were getting made. It may well be that some of their expectations did change along with some of the market analysts at that time. Did their risk tolerance change? Perhaps it did, but I think also risk tolerance doesn't necessarily change on a continuous basis. The global financial crisis as an event provided the impetus for people to think about it, to think about what risk they're comfortable with, or to actually think, well, what I thought risk meant is different to what it's getting played out like. So perhaps as an event, it forced people to think about their risk tolerance. It may not have actually changed their overall tolerance. I think the funds themselves in their communications, they provided some cues. One quote looking at or characterising how the fund itself was reviewing their investment strategy. Effectively, there was two messages. Effectively, they were saying, we're not changing our investment strategy, our long-term strategy. There's very few funds who said in their 2008 report that they were doing that. But at the same time, a number of funds were saying that in the short term, or if you like on a tactical basis, they were building up cash and indicating that they would re-enter the market later on, which I think that has an injunctive quality for members perhaps who are thinking about a change and thinking, well, I might do the same thing. and some of them did. So what are some of the potential issues for trustees? Well, I think the behaviour of the majority of members underscores the importance of the default for members. And I guess the question is, can a single default still be the best option? For the great diversity of members within a fund, can just one option be the best? For those who do make a change, it appears for them at least, age is an important discriminant. So again, balances and contributions are important, but age is also, I think, a key discriminant for the types of changes that are made. So I guess in a way that's suggesting perhaps a greater role for age-based defaults. The position of the default, or how it's framed, is important for members. It's not only important for those who don't make a choice, but it's important also for those who do end up making a choice. So just the number of options that are available and where it's positioned has an impact in terms of how much risk or how far members want to move. If they want to move up or down risk, the number of options that they have to go to can influence, one, their decision to move out of the default, and then how far they actually go. I see there's a potential, a difficulty for trustees when they're communicating for members, because they're really communicating to two different groups. They're communicating to the majority who don't make choices, and they're also communicating to the minority, older members with larger balances who are making choices. To the defaulters, if we could characterise them in that way, they're highlighting the strength of their investment strategy. They're trying to be reassuring. They're saying that we're sticking to it, but we are reviewing investment strategy at the same time. So it's getting consumed by changes and non-changes. So to the defaulters, the aim is to reassure them. To the people who are going to make changes, it's in some ways it's a bit of a do as I say, not as I do sort of a message. So I guess it's difficult, I guess, to distinguish between those. More broadly, in terms of investment choice philosophy, the question of cost. What does it cost to offer choice to members, and are those costs transparent? The Cooper reviews looking at the myriad fees that are applicable that get imposed on funds and that the funds impose on their members. But I guess investment choice is a way in which members can impose costs on other members if the costs aren't transparent. Because those who are exercising a lot of choice, just in the architecture of the choice options or administering it, that can impose a cost on the others if it's not recouped. In terms of how the optimal design of choice menus, how frequent should it be? Should it be monthly? Should it be daily? It's the example of a fund offering monthly choice in October 2008. I've got a large balance and I'm close to retirement, and I see the market going down and down and down, and my choice is not becoming effective until the beginning of next month. The question is, that might be a good thing in that things don't happen until a month's time, but it may be a bad thing. One gimmicky clip art. For those people who stick in the default, what's going to be the impetus for them to change? There is evidence that rebalancing is in their interests. Perhaps there's a role for having some sort of a focus day, a coordinated day across the industry, something like a super day to rebalance. Why not have 25th of September, which you all know is Christopher Reeve's birthday, the silver screen Superman, or you could have the, I think, 1st of May, which is George Reeve, the small screen Superman. That could be one means of mitigating the prudential risk of that funds face. And it also suggests perhaps automatic rebalancing could be an option to include with choices when they're offered. So I guess turning the thing around from asking why or how do we get members more engaged, perhaps how do the trustees get more engaged perhaps with some of those members making choice. Thanks.
So I've been asked to provide some feedback on Paul's research in relation to CBUS. So I plan to give you a brief overview of how the fund has responded to conditions over the past couple of years, our experience in respect of member switching and the impact on the fund from that switching, and also some recent member research that we've undertaken with our members and what we're planning to do with the results from that research. Just a bit of a recap on CBUS. We've currently got about $13 billion in funds under management, around about 65,000 participating employers, and the number of members is around about 580,000, and the vast majority of those are working in the construction, building and related industries around Australia. Fortunately, CBUS continues to be a fund that is growing strongly. Our membership has continued to increase even throughout the downturn over the past couple of years, and we continue to receive a very strong level of contributions into the fund. Just to put that into some perspective, after all benefits and expenses are paid out, we still have net cash flows for investing averaging around about $100 million per month. So that does give us a lot of flexibility in implementing our investment strategy. Okay, so the GFC has obviously resulted in 2 years of negative returns, which have significantly impacted on our members' superannuation balances. CBUS has attempted to shield members somewhat from the downturn by taking some risk off the table in the investment strategy. We started to do that in early 2008. The main changes that we implemented were within our core strategy, and that is our default strategy, and it represents over 92% of our membership. So within that strategy, we substantially reduced our allocation to equities and increased our allocation to cash. That was the main changes we've made. We also maintained a very cautious approach to sort of what we saw as very risky, highly leveraged vehicles that were being offered. We also sought to position the portfolio to take advantage of some of the dislocation in the market. So very early we took some exposures to distressed opportunities, and more recently we've put some money into credit. At the total fund level, we've also sought to protect our members' accounts by containing the costs of running the fund, and that's been implemented across the years through some pretty rigorous budgeting exercises that we've undertaken. What we've also sought to do is to renegotiate our fund manager fees wherever possible, and we've done that with some limited success. And I have to agree with some of the speakers over the last couple of days who have been mentioning that I do believe that fund manager fees have got some way to go down. The past financial year certainly saw some increased pressures on CBUS's cash flows. We saw that the increased level of unemployment was likely to decrease our volumes of SG contributions into the fund. On top of this, member anxiety had the potential to result in an increase in members exiting or seeking hardship claims, reducing their voluntary contributions or switching to the more defensive investment strategies. So these pressures were also in addition to the existing cash flow challenges that we had from commitments such as private equity and infrastructure and property. We had some significant commitments that were being drawn down on. We also had to meet our currency hedging rollover positions over the year. But really the main area of watch for us was in respect of switching, and we had a net amount of 326 million that actually moved out of our higher growth strategies into capital guaranteed over the past financial year. The high point was in October, and that was pretty much straight after all of our statements were issued. 80 million was switched into capital guaranteed in that month, and that came out of our $100 million that we got from cash flows in. So at the height of our switching, we have monitored and we've stress tested our cash flow position. We did this in a number of ways. We modelled the impact on the fund's cash flows to a significant increase in unemployment. So we stress tested the cash flows up to an unemployment level of 15%. We also modelled an increase in exits, so we assumed that they were going to double, and we also modelled a doubling in our switching. So fortunately, we have not seen these stress levels eventuate. What we've actually seen is that the trend is now reversed. We've got members moving back into the higher growth options. They're moving out of the capital guaranteed. The rate that they're doing that is around about $5 million per week, or $20 million a month. So it will take some time for those that have moved out into capital guaranteed to move back. Some of the lessons that we've learnt during this period of time is that the fund does have really strong cash flows and liquidity position. CBUS members in the main appear to trust the fund, and they're pretty inactive when it comes to switching. So while 326 million does seem quite large, it represents only around 3% of our membership. So the vast majority of members have stayed in the default strategy, and those that did switch out are slowly starting to switch back. However, the past year did demonstrate to us that a small number of our members do react to short-term market moves, and also to the receipt of their annual statements. And also that members required some increased support from communication and financial advice. So as a result of that, we now have a new dedicated call centre with the skills to provide financial education and advice to our members over the phone. And we have increased communications to seek to reassure and educate our members about the market environment, their options, and how they can seek advice. This slide just shows a breakdown in our recent in that switching behaviour over the past financial year into the age groups. It's consistent with the research results. Most members who switched were in the older age group, and they were the ones that have got the higher account balances. Most of those members, 86 or 87%, only switched once during the year. About 11% of them switched twice, and just over 1% switched 3 times. At the very extreme, we had one member who was at age 55 who made 13 switches during that year. We were anxious that members' perception of CBUS would be affected by the market downturn. So following the distribution of the member statements in September last year, we actually conducted some pretty extensive member research to understand how our members felt about the fund. We were pleasantly surprised that CBUS recorded a very high member satisfaction rating, and as part of the research we delved into the things that were driving that high satisfaction and the underlying drivers of our strong brand reputation. So this gave us a good picture of what members expect from CBUS. The main expectations are shown on this slide. Some of the key investment messages to us were that CBUS is a trusted expert. So while our members see themselves as being experts in their particular crafts in the building and construction industries, when it came to super, there was a lack of understanding, and they expected CBUS to be the experts, and they trust us to make good investments on their behalf. Our members also want us to keep it simple and relevant. So members in general don't understand superannuation jargon. They want CBUS to keep the information simple and easy to understand. So a part of that keeping it simple was that they don't want too many investment options. So we also undertook some further research earlier this year, and that was in particular across our investment strategies and options. The primary objective of that research was to identify the range of investment options that most suited our member needs, and determine if we actually needed to increase our number of options. At that stage, we were considering perhaps introducing some asset class options. So the key findings from that research were that members do want some choice. So one option alone is not enough, which is actually quite an interesting result when over 90% of members will actually never exercise that option. They do put some value on actually having choices. Too many options was too confusing, so members were saying if they had 9 or more options, it's too hard to make any choice. So there seemed to be a sort of a sweet spot around 5 investment options, and that's what they were saying was their ideal. The other key finding from the research was that members place a large emphasis on the names of the investment options. Therefore, the names need to convey a sense of expectations of returns and risk. What came out to us as clear from this research is that members found the name of our default strategy quite confusing. The core strategy doesn't really mean much to them. So we will be reviewing that. It was actually also quite interesting for us to find that members often perceive that core strategy to be quite a conservative option against the other options that we've got in the fund, and in actual fact it's not. So looking forward, there are a number of actions that we are undertaking. We're reviewing the number of our investment options. We currently offer 6. It's likely that will be reduced to 5 or possibly 4. So we're picking up there that our members are clearly indicating that they want less choices and clearly differentiated choices. We're also reviewing the names of our options. We need to get some names that actually explain to them what the risk-return profile of the options are. We are reviewing our investment risk disclosure. Financial crisis has brought to light our members' limited understanding of investing, risk and return. And it's clearly highlighted some opportunities for us to improve our approach to explaining these. We've also been in discussion with ASIC as part of the work that they're doing in this area. So improving the way that we explain investing, our investment options, risk and return is one of our key projects for this financial year. We're also seeking to enhance our approach to communication of our investment strategy. So we're currently recruiting a communications specialist who will be an integral part of the CBUS investment team. And they'll have the responsibility for enhancing our framework for delivery of the key investment messages across all of our stakeholders. Thank you.
I'm going to talk to you a little bit about our fund, and it is different to CBUS. We have a single industry, the electrical supply industry up here in Queensland. We have 21,000 members, and I didn't put the funds under management because the update today was about 2.7 billion. The average account balance in our defined contribution is 75,000, but you'll also notice we have a hybrid fund and have a defined benefit group of members, and their average account balance is around 295,000. Our membership, on average, members have stayed with us for 10 years and more. In fact, we have some members who've been with us for 50 years. We have 10 investment options, 2 of them are closed, and our service model includes financial planning, administration, call centre, all managed in-house. Briefly, the member numbers, you can see quite clearly that our defined contribution as far as membership numbers is quite large, but under the funds under management, you can see that it's got a smaller portion of the funds under management. Now, what that means is that we have a fair proportion of our funds under management belonging to members who have enjoyed no investment risk. And so one of the challenges that we've always had is trying to educate and engage our members on investment options, in particularly when they move from defined benefit, in a lot of cases, to defined contribution or to the pension division. There is no pension option available for a defined benefit member in our fund. So then I thought, well, let's look at the defined contribution and let's look at choice. And I know that there's been some talk about whether choice is actually a common cause or not. And when I looked at the choice within our fund, I found that we had a fair percentage of members who obviously have made a choice. We also have a fair amount of people who are in our default. Now, what I wasn't able to ascertain was whether those people were there on purpose or whether they had just exercised apathy and stayed there because that's what we defaulted them to. You'll also notice that I've carved out there a little bit of an employer default area. Now, the reason why I'm putting those into a choice bucket was because that they have we've closed that default, and we wrote to all of our members and we tried to encourage them out of that default because it is a smoothed investment option, and we we still have quite a few people in there, and so as a result, a lot of those have made a decision to stay there. So our switching experience, was it much different to what Paul had found with the groups that he had studied? One of the things we did do in, I said December 09, but in fact it was December 08. I'm not ahead of myself, so apologies about that. But we did set up a cash deposit investment. We have a fairly high engaged membership, and our board is fairly close to the membership, and we had a lot of our members talking about the guarantee from the banks and so forth. And as a result, the board decided to open up a cash deposit investment. And as a result of that, since December 2008, we've had 32 million switched in, and which works out to be about 2.5% of funds under management. Now, what was really interesting was when I looked into that one, it's actually fairly even between the pension and the defined contribution members who actually rolled in there. And when you look at the average age of about 48 for the switching in our fund, you can see that we've probably had a fair amount of the older group doing that sort of thing. Now, the movement in the actual allocations amongst options, we saw a 1% increase in our super movement across the options, and the pension options went up by about 10%. Now, we have a fairly close tie with our financial planning group with our pension members, and anecdotally, when I speak to our financial planners, we often found it was the pension members who were really struggling in this investment environment. And we, as a superannuation industry, keep talking about long term, and we keep talking about, investments for the long term. But these are a lot of pensioners who have moved into the pension phase, and their definition of a long term is obviously a bit different to the people in our defined contribution. But overall, the number of switches grew by 30% in 2008. How does that compare as the number of members to what, Paul? Our switching numbers came in at about 4.9% of our members actually switched during this time. And of that 4.9%, I think the maximum number of switches that we had occur, particularly over the last year, was 5. So we also found that the average age of our switches was around 48. Interesting enough, the average age of our membership is 43. So we saw a fairly good distribution across our membership as far as switching goes. So why do we think we've got a fair amount of members who have choice and have done the switching activity that we've seen? We have a very close relationship with our employer group. We have 20 employers that we deal with across Queensland who have the majority of our membership. And as a result, those employers, and I think this is kind of special in the superannuation industry, but those employers still see superannuation as an employee benefit. And as a result, we enjoy the ability to get into our employers' sites and to spend a lot of time on site educating our members about superannuation and about investments. And while we have a fair level of apathy around the younger generations, we do still see a lot of these people turning up to our seminars on site during work hours. We also have a financial planning group who've been fairly strong, and we've had those people in place for almost 5 years now. And they have enjoyed an enormous amount of work that's come through from our membership. And a lot of our pensioners who have come through with our financial planning group. We have 9.5% investment-related calls over the last year, which has resulted in single-issue advice, but also invitations to seminars. So we often hold off-site seminars and seminars within regional activity. We also have our financial planners move around and do seminars across Queensland as well and through the regions. But we also have, and I talked about our defined benefit, and one of the things that we have recognised was that we do have a challenge with those group of members as they move out of the no investment risk phase into an investment risk phase. And so for some time now, we have been calling a number of our members that we have identified that we believe would need some sort of investment help and some advice around the investment side and the investment choices. So we have had outbound calls in place for some time. So let's have a look at what happened in our fund and what was the trend. So I don't think we're any different to what we saw across the industry, and that was that we saw a reduction in our balance fund and we saw an increase in our cash, and that comes through quite obviously. Now, this is a joint movement across both super and pension, and when I split that out, there was really not much difference between that movement. So for both the defined contribution and our pensioner members, we saw people moving from the balanced into a very low risk cash environment during the switching process. Bear in mind that, of course, we were only talking about 4.9% of our members who did that movement. And again, we have, as I said to you, we have a number of seminars, and we had one in March, which was kind of in the middle of the whole time of people not actually knowing where the market was going to go. And we had about 500 members turn up to the seminar, and it was all about investments. And we often enjoy, after that seminar, I enjoyed the time of actually walking around and talking to our members. And there was a lot of concern around about whether a person could manage sleeping at night, knowing that their superannuation accounts were going down. So in awful fact, it wasn't about trying to time the market, it was all about trying to get to sleep that night, knowing that your investment when you wake up the next day wasn't going to have dropped by another X%. So there was a lot of that sort of anxiety that was going across our membership as well. I thought I'd have a quick review over the last 2 months, since 30th June, and this is probably after Paul's survey, and I thought I'd have a quick look and see what's happening with our membership since that period of time. And interestingly enough, you can see the cash options going down and Australian equities starting to rise. So while we're talking about people wanting to sleep at night, we do have some members who are actively watching their superannuation and moving with the market. So then I thought, okay, so we've got all this choice. Have they made the right decision? What are they doing? And I looked through on an age-based relationship, and I said, okay, so who in our age groups, what are their exposure to growth assets? And you can see quite clearly that while we have fairly large amount of choice, we still have 80% of our membership, or roughly around 80% of our membership, in each age group sitting in the 70 to 90% growth assets ranges. So I thought that was quite encouraging from a choice point of view. I thought that was quite encouraging from a membership educational point of view. But you can also see that we have some outliers. And so we do have a number of our people 30 and less sitting in a less than 20% growth, and vice versa, people in the 50 plus sitting up there in the 90% growth area. So from our point of view, what are our next steps? So we're going to continue with our face-to-face seminars because we think that that's working. We have that as one of our strengths. We have the ability to do this, and it seems to be working quite well for our membership. One of the other anecdotal things that we were getting back from our membership was around investment knowledge, and that was particularly around about how their superannuation and their investment options were travelling. So we're obviously focusing, and I'm sure there are a number of other funds who are also doing this, what sort of information do we need to provide to our members to keep them educated and informed? Financial planning, the outbound activity will continue, and we will continue to talk to our members and try to talk to them about their investments, and particularly in what we consider some of the high-risk areas. And I showed you those outliers, and that's one of the areas that we'll be focusing on, talking to our members in the outlying group to try and make sure that they are in the appropriate investment options that meet their needs. And we will continue to give them investment choice and through the financial planning.